Hi, everyone. Welcome to our workers' comp webinar. It's called The Life Cycle of a Workers' Comp Policy. My name is Anae Agostini. I'm CEO of CID Insurance Programs. I'm going to be one of your instructors today, and along with me, there will be Cesar Serrano, our senior work comp underwriter. Say hi, Cesar.
Hello, everybody.
And Lexi Goldspring, our work comp renewal underwriter. Say hi, Lexi.
Hi. Hi, everyone.
So I think we've got a number of people ready to go. So let's get started. Next slide. So what are our objectives? So workers' comp is probably one of the coverages most misunderstood by insurance brokers and insureds. So the objective is to better understand and manage workers' comp insurance. The other aspect that we want to cover is to talk about audits, cancellation issues, billing problems, ex-mod factors, and waiver forms. These are all some of the most confusing and most frustrating for you as brokers and your insureds, and cause the most havoc. So we hope to enlighten you a little bit so you can work better with your insureds. And then we want to be able to learn how to obtain new business workers' comp quotes and then hold on to your renewals. So let's actually dig in. Okay, so start with the basics. What is workers' compensation insurance? So it's really designed, it's a statutory legal obligation, and it's a state regulated. It's mandated by the state. It's not federally mandated, so it's going to vary by state. As many of you know, each state can make up their own set of rules for how they want to handle whether they want workers' comp to be a requirement for employers or not. So it's a type of insurance purchased by employers for the coverage of employment-related injuries and illnesses. It's intended to cover wage replacement and medical benefits. But again, all of this varies by state. Each of your carriers, they're going to develop classification codes using actuarial calculations. So the rates that they're developing are going to, each carrier can have a whole different view of different classification codes. So that's, that creates competition. So it's always good. And that's one thing we do every year is we do shop the workers' comp to make sure that that the renewals are going to be competitive, the most competitive that can be out there. So let's move on and have Cesar talk about new business quotes.
All right, thank you, Anae. The new business quotes, we're going to start with a completed Accord 130 application. Always preferable to have one that's nice, neat, and legible. Great resource for it is if you go to CIDinsurance.com, you can find the Accord applications on the website there, and you can download a PDF fillable file for that. So it'll be really easy. That way you don't have to handwrite anything. The most important parts of completing that application is going to be the federal ID number or the FEIN number, the contact information, and a clear description of what the employee duties are for each classification, and if they have previous coverage to notate that on there, and of course the payroll designated or estimated for on an annual basis for each employee. And at least if they have previous coverage, we would want to at least have 4 years of loss history, currently dated loss history, on there as well. For larger, on the next slide, for larger new business accounts also, it's basically the same thing. I may ask for a supplemental application. Again, you can also obtain that on our website. A lot of the different business types that are on the work comp section will also have a industry specific supplemental application, and also there may be a generic one as well on there. But for the most part, as far as the large accounts go, are they experience rated? The easy way to find that out is through the Work Comp Insurance Rating Bureau website, or you can call them up and find out if they have that. Typically, that's tracked by the FEIN number that I talked about earlier, and again, that's why it's important to obtain that number when you're getting the information from the insured. Do they have a loss control program in place? Do they have a history of frequent losses or large losses? Would be important to know. And can they benefit from having a program in place, a injury and illness prevention program in place? Do they have a dedicated person working on claims with their current carrier as well? All those things are just very important to know and to maybe establish with them from the get-go when you're working on the larger accounts.
Okay.
I think
I'm going to talk
it for that one.
Okay, perfect. I'm going to talk a little bit about work comp premiums, how they're calculated. So work comp is an open rating system, at least in California, and to my knowledge, any state that's requiring it, it's an open rating system. Back in, I think I remember 1993, it was a closed system. All rates were everyone had to offer the same rates. There was no competition, and then it split wide open around 93, 94 when they made it an open rating system. So now it's a competitive field. So the rates are determined by the carrier's own class code claims experience. So that's why it can vary by carrier as far as what their rate is going to be for a specific class code. The Workers' Comp Rating Bureau, they can make recommendations, but it really ultimately ends up being the carrier's choice to choose the rates, and it's done semi-annually. So you'll see July 1st and January 1st where you hear the carriers talking about, well, we're going to have a rate decrease or a rate increase, and it's never across the board. They're going to have some class codes that go down, some that go up, and that's all depending on what their results end up telling them from previous year's experience or previous 6 months experience. So from that standpoint, I'm going to go into a few slides that talk about understanding the formula, the base rates. And can you go back one more slide, please? Thank you. I'm going to just talk a little bit here first, and then I'll prompt you to the next slide. So understanding the base rates, the carriers actually establish these base rates by the actuarials, but they further break it up into territories. So it's important to understand that, like Los Angeles versus San Diego in California, Los Angeles is going to probably have higher rates. So they're going to debit or credit based on the performance by territory. So it's important to understand that part of it, because it may not make sense to you that a rate, you get a quote in LA and on a quote in San Diego and completely different rates. That's what's driving it. I'm also going to talk a little bit more about the base rate adjustments, how you can get premium credits applied, and how to do that to your advantage to get the maximum amount. And then also the experience modifier, premium credit or debit. So let's dig into the base rates. Okay, this is really, a lot of you don't necessarily understand this formula, but it's a really simple one. The base rates are, you multiply the base rate by class code times the payroll, and then it's to the 100th, and that's how you get your premium. So there's an example below that shows the $3.44 times 100,000 in payroll, and really you're dropping 2 zeros. So you really times it by 1,000, and that's how you get a premium of $34.40. That's an easy way to explain it to your insureds. So again, base rates are established by the actuarial calculations, and it's really important. I think I mentioned that each carrier is going to have a different loss history performance based on their experience, and so. But it's really important that you get your employee classification codes correct, because the audit can wreak havoc if the insured does not have them classified properly, like you're trying to slip a higher exposure employee into a clerical category because you want the lower rate. It's going to get caught at the time of an audit. So it's just always important to not have that stress for your insured or potentially surprise an increase in premium. Okay, let's move on. All right, so once we've got these base rates already figured out, how do we get maximum premium credits applied? Well, premium credits are usually vary from about 25% to 40%, depending on the carrier, and that can make a substantial difference in the policy. And it's one thing we all talk about. Well, let's apply maximum credits, but what does that really mean to a carrier? To a carrier, it really means that we want to know that there's a reason. They need to substantiate, and to the Department of Insurance, they need to substantiate it when they're audited that their credits are being applied for with purpose. So here are some of the things that actually can create that purpose. So an established illness and injury prevention plan, IIPP, is an important way, and that should be a norm. So if you should be asking your insured about that, and if they don't have one, we can give you some. We can point you in the direction of being able to get some templates depending on the industry they're in, so that they can actually develop one and have one published. Managed health care programs. All carriers have their preferred healthcare system that they want to drop the insured's employees into, and so always encourage your insured to get a list of where those the healthcare programs are for their particular carrier, and pick one that's very close to their company, so that it makes it really easy at the time that they might need to use that or send an employee who's been injured. Safety drug alcohol awareness programs is another super important area to address. At the same time, return to work programs are really big these days, because most of the carriers are using the Salvation Army as a means to return people to work that the doctor says they cannot go back to their original job and function in those duties. So the Salvation Army puts them to work, the employer pays for it, and it's a great way to find out if an injured worker is really serious about coming back to work, or whether they're playing with the system. So and that's an important way to get some credits applied. Good claims history is always an important factor that can get credits applied as well. And then your experience modifier will naturally add some credit or debit, which will be to your benefit or not to the benefit. And again, that we're going to talk a little bit more about that, but not all policies have an experience modifier. So let's move on. Okay, well, let's talk about the experience modification rating system. So this is your larger accounts will automatically get notice from the Workers' Comp Rating Insurance Bureau that they have when they are automatically they qualify to become on this program. And so what are we talking about here? We're talking about an X mod rate, and it's designed to either credit or debit um, premium incentives. Okay, it's a state-mandated rating system that monitors and measures claim activity in larger accounts. So, and the Bureau monitors the claim activity. They compile this unit statistical report, and that actually calculates the XMOD percentage. So, how does it happen? You get notification that you qualify for it. So the date that you qualify for it, then you're going to roll 3 years, and then technically, it actually you won't see your modification factor published or affecting you for actually 4 years and 9 months. So you can see by the chart how it works. But it's always going to be measuring three years rolling. So you're essentially looking back by the time they publish. So if you have a bad loss, it's not going to show up, right away, but within 18 months you're going to see that mod show up, and it's going to continue to roll. So you could have 3 years of a debit that because you're paying the price for some bad claim activity. So it's this is a really good motivator for managing claims and keeping the claims down. Okay, next. All right. So I talked a little bit about what the experience modification factor. It really is. It was designed. Its purpose is really to actually to give an incentive for larger companies to manage claims, and that I think that probably speaks for itself. It's going to obviously penalize those that don't have good claims history, and that I think is the purpose, because it becomes so difficult for carriers to stay in business writing workers' comp insurance when claims are excessively high across the board. So that was the purpose that it was designed for. So how does it work? So it's actually they're measuring the insured's actual losses to as a percentage, and it compares the losses or claims history of one company to all other companies in the same industry within the same state. So you're basically, your loss history is measured against all the other businesses like yours in your state. And so if you're, so what's the potential impact? It can be a good thing or it can be a bad thing. If your actual losses are greater than the expected losses of the industry, of your industry, then you potentially are going to have a debit, and you will be paying more in the form of a debit. If they're less, then you're going to receive a credit. What does that look like? So it's measured in a percentage. So let's start with even Steven at 100%. So there's no credit, there's no debit. You're even at 100%. So the minute your actual losses go over the expected losses, then you're going to move to the right, which is going to be an increase, maybe 105, 110. I mean, I've seen some really bad ones, 200, 300%, and that hurts because that's the percentage you pay. If you're paying $20,000 in premium, then and you have a $300,000 300% mod rate, you're going to be paying 3 times $20,000. So that's it in a nutshell. So on the other hand, if your actual losses are less than, then you actually end up with a credit, and that can be a substantial credit. So really, you can be paying far less than what was quoted by the carrier when they apply the experience modification. Okay. Caesar? Oh, one more thing. Workers' comp, here's the actual rating worksheet from the Bureau that the Bureau publishes once a year. This usually comes out on January 1st. And you'll see up at the top right that that's where your experience modification percentage, this one happens to have 111% modification. and so they're getting a debit of 11%, as I mentioned before. This can be found on the Workers' Comp Rating Bureau website. And it gives an explanation of what all those numbers stand for if you need to get into further detail with your insured on how to read it.
So how do you best present the rates and premium to an insured? It doesn't have to be very difficult. We do have a template for proposals as well on the next slide, but you want to take the classification code and the description of what it is, and then show what the rate for that particular classification code is and the estimated annual payroll amount. The net rate should also show somewhere on that form. It can be either right next to the base rate, or you can have it off to the side a little bit. I typically do that on the quotes that I present. Is just off to the side, I will show the class code and then the net rate for that particular class code. Show any discounts or credits that are applied. Like Anay said, there could be experience modification credit or a debit. There might even be an industry credit. They might be part of an apartment association or a restaurant association that might be partnered with one of the carriers, and you might be able to get a credit that way as well as having the IIPP in place and things like that to show on there. Show that by a percentage amount. You can, if they give you a 10%, 15% credit on there, show each of those credits and how much that credit amount is, to show that how you reached that net rate. Show the state assessments on there as well. You can indicate what those state assessments. If it's California, it's going to be several different assessments that are going to be grouped together, and we just typically show it as just one line item for state assessments, and then the total, obviously the total premium after all the credits or debits are applied. On that next slide, you'll see the actual template that is used for that. It's always better to show the full base rate and the net rate on that, and then the credits. Billing terms, just let them know what their option is. Typically, I will show the best billing terms option on there, but there can be several different options, from a full pay to monthly down payment plus 9 installments or 10 installments, or even up to 12 installments. It just really depends on the premium amount, because it's a small premium. There may not be so much room for installment plan, but once you're getting up to the bigger premiums, you'll have a little bit more options, including pay as you go and things like that. Lexi?
Okay, thank you, Caesar. So I will be covering the renewal process with you all. We begin our process of review about 60 days in advance from the effective date of the policy. And this review, it includes verifying payrolls, addresses, ownership. Also, we take in consideration remarketing with another carrier, depending on the premium size and the risk, of course. So we do request from the broker to provide an updated Accord 130 on file, just so we can verify all information is accurate on the policy. Just by case situation, most of the time renewals under about $9,000 to $10,000 in premium, they'll go through an auto renewal process. So the insured will receive auto renewal terms from the carrier directly, but we are still sending the broker the renewal proposal, which from there we expect the broker to be sending directly to the insured as well. And the last thing I want to mention on this slide, if you're not able to retain the insured, the carrier will require a signed LPR form, which is a cancellation request form. And that's if you're canceling or non-renewing coverage, and you can find that on our website as well at CIDinsurance.com. So moving on to the next slide. Okay, so how to guarantee renewal success. So some of you do have larger accounts, which of course brings more competition. So it is important as a broker not just to present the rate to the insured, but also all the services the carrier has available. So there are carriers who have better services, and we can present those to you if you're unfamiliar. Of course, you don't want to lose out on these larger accounts, so providing risk management tools to the insured can be very helpful. Each carrier, they provide safety tools that you can find online that are completely efficient. So we definitely recommend to invest time looking into those. We do work with the top carriers in the industry. They are straight work comp writers, so they do an excellent job in claims management and loss control. So there is, as you know, there's no faster way to lose a large account than mismanaged claims. So you do want to be looking for a carrier that has in-house claims managers. That is the best method. So now we will cover waiver forms on the next slide. Perfect. All right, so the Work Comp Rating Bureau, they made this law effective January 1st, 2017, and basically it was to revamp who is allowed to be excluded on the work comp policy. They made it more restrictive on who's eligible. So the exclusion forms, they apply to corporations, partnerships, and LLCs. So for a corporation, those who are eligible would be all officers or members of boards of directors who individually own 15% or more of the outstanding stock. Then regarding a partnership or an LLC, this would be all individuals who are general partners or managing members. They would need to fill out that waiver form. And then on individuals, they are automatically excluded from coverage. So just a couple cases when the exclusion form is required. Number one, the waiver forms, they're required if you're writing any new business policies. So if you find a new business with Caesar, then you'll need an exclusion form on file if they're eligible. Number two, if there's any change of entity structure during the policy period. So for example, if it's a corporation, changes to an LLC, updated forms will need to be refilled out. And then lastly, if a policy is remarketed, so let's say they're with employers and we remarket them with AmTrust, a new waiver form must be completed as well and sent in. The forms are catered toward a corporation or an LLC in a partnership. So whoever's filling it out, they'll just need to make sure it's the correct form designated for that entity and also that carrier. And then lastly, just make sure to be careful in filling out the form, making sure the policy number, the name insured that is listed on the policy is also written on the exclusion form, just so we can avoid the carrier rejecting any exclusion forms due to the information being incorrect.
As far as the endorsement requests go, a lot of the typical type of stuff that you're going to get is maybe like a waiver of subrogation endorsement request for that. That's basically just a contractual agreement that somebody might have with another party, and they want to just protect themselves against the carrier. The carrier agrees to not to go back to the party requesting that waiver of subrogation, even if they're partially at fault for an injury. Another one would be for an ownership change. That would require a 601 form. That's a form provided by the Work Comp Insurance Rating Bureau, at least for California again, that you would need completed in order to show the changes in ownership that may occur. Other types of endorsement requests would be like a payroll change that you might have, either an increase or a decrease in payroll, or just a simple address change that may, added a location, or maybe they just moved locations. Then those are the type of requests that you might want to be requesting for that, especially on a location. If there's an additional location, you want to make sure you get that payroll information for that, because that means that there's going to be some additional premium that's added onto the policy that you would want to pick up midterm versus at the end of the policy period via the audit.
Okay, and moving on to direct billing. So all work comp policies are set up on direct bill, so the insured will be making payments directly to the carrier. They're set up on a stipulated pay plan, so basically it's a premium based on payroll that the insured agreed on. The policy will be divided into a down payment with an installment plan following that Caesar covered earlier. This makes it easy to tell the client they're guaranteed the same payment each month, which then produces a stable budget for them. So some policies will include a wholesale broker fee charge. When a policy has this, just pay attention to where we are requesting the down payment to be sent.
Okay, I get to talk about something really important to each and every one of you. That's your commissions. So work comp is all direct bill. So it unlike agency bill where you deduct your commissions up front and just pay us the net premium due with fees and whatever else that goes along with that. Direct bill uh, is paid based on premium payments received by the carrier. So we pay you commissions when the carrier pays us. That is what that it ends up coming down to. So it's there are you've got agency billing, which you're going to handle out of your trust account to pay us the net premium and keep your commissions up front, and then you have direct billing, which on this side we're actually going to be paid by the carrier, and then we are going to cut a check to you directly monthly. And the downside of it, there are carriers, a lot of preferred carriers out there on for your BOPs out there and things like that, where they will annualize the commission. And unfortunately, workers' compensation does not work that way because of it's they're all audited, and so they don't have the luxury of paying annualized commissions up front. The carrier pays when the insured pays. So if they're on a payment plan, then the commissions are going to trickle in based on what they paid the carrier. So just keep that in mind and be patient with that process, because there's no way around it, and there's no carrier that does it any differently. So that option is off the table for annualized commissions. So you'll get paid as your insured pays. Okay. And our favorite subject, premium audits. This can be one of the more frustrating things, but my whole thing is, what a shame to lose a policy over noncompliance to an audit. So I want to talk a little bit about this so we can help. It's important for your insured and for you to know, if you don't know, that all work comp policies are subject to a premium audit. There's no exception. That's mandated by the state, that they actually come back around and determine whether the payrolls were accurate, so that the accurate amount of premium was charged for the full exposure. The carriers must do this at least annually. I used to see sometimes more, right, and sometimes with greater exposure type class of business, like let's say a big contractor, they might go to monthly audits because there's such a roller coaster ride with payroll potentially. But then some other businesses where the payroll never changes monthly, then an annual audit is going to be sufficient. So what kind of audits? There are really basically two: a voluntary audit versus a physical audit. Most of all your smaller policies, and that's the majority of them, when you really look at a carrier's book of business, are going to be voluntary audits, and that's where a form is sent out by the company, an audit report that needs to be completed by the insured, and they usually receive that, within 60 days of the policy expiring, and they're already they're into the new renewal term. They'll receive the audit report. However, there are some. Alexi's going to talk a little bit more about this. I'm not going to get too involved in that. And then there are physical audits, and the larger risks will have someone from the carrier that will go into the office and actually go into the accounting department of the company and actually physically audit their books. So it's important to understand which type of audit you're dealing with. It's also the last thing I want to mention is that these auditors are when they do a physical audit, they're looking for any uninsured, unlicensed vendors that actually could be deemed an employee if they were injured. If they can't prove that they have a license, that they have their own insurance to cover their own exposures for worker injury, then the carrier will most likely consider them an employee. So they're either an independent contractor and they can prove it, or they would be deemed an employee, thus their payroll. Whatever you paid that vendor would be included in the audit, and you would be paying premium on that. So it's really important to keep that in mind. Lexi, I'll let you take it from here.
Okay. So I'm going to cover some issues to avoid just so the audit process is very smooth for the broker and the insured. The insured will receive the initial audit report, which is mailed directly to them before the policy expiration date, which Anae covered. It is essential that the insured completes this audit report to avoid noncompliance. So noncompliance can result in 3 issues. Number 1, an estimated audit will be issued charging a large amount of additional premium. And then number 2, a cancellation notice will be issued on their current active policy due to noncompliance. And then lastly, if the audit goes months being noncompliant, then an outside collection agency will step in at that time, which of course we want to avoid. Most of the time, the auditor may reach out to the insured directly requesting additional payroll documents, such as quarterly 941s or payroll summaries. So it's important to keep in mind, even if the audit report is filled out, but they haven't sent in those additional payroll requests, then the insured will still be marked as non-compliant. So they have to make sure they send in everything along with that audit report. I do want to mention also if the audit comes back and, payroll is higher, maybe the company grew throughout the year, a payment plan can be negotiated on that final audit amount. But if the current policy goes in the cancellation, let's say due to that final audit premium amount, then it is off the table at that time. We cannot negotiate a payment plan. So please always communicate with us on that. Basically, moral of the story, just make sure the insured complies with all documentation requests. Please be very proactive with the insured when we forward those audit compliance reminders. And then if you have any questions, you can reach out to me as well. And then lastly, okay, so we'll be covering, of course, what we never want to happen, which is cancellations. So the carrier will send out cancellations for the following reasons. It can be due to non-payment, non-reporting, or even a material change. So non-payment is pretty self-explanatory. If the insured does not make a payment on their policy or they're past due on an installment, that cancellation notice will be sent out. Non-reporting, it links together with audits. If the insured's non-compliant, then again, that cancellation notice will be sent out on their current policy. And then material change. For example, let's say if the policy is written for a landscaper who only does general landscaping, but the carrier finds out that there's tree trimming, which is a huge exposure, then the carrier at that point would send out that cancellation notice, giving them 20 to 30 days to find coverage elsewhere. So the insured, they will be receiving a cancellation notice directly from the carrier, and then I also will be sending the broker that cancellation notice. So please always just be very proactive in making that payment or sending them that audit information before that date passes. It's important to be aware if a cancellation is issued due to non-payment on the final audit amount and that cancellation date passes, and let's say they make their payment after, the carrier will not reinstate that policy. So that's just something to keep in mind, to be aware of. There are a number of options to make a payment for each carrier. Even the same day, they can make a payment online or over the phone. So there should be no reason why policies cancel, and hopefully we can always avoid these in the future.
Great information. So thank you for joining us, but I'd like to open this up for questions and answers. So please start typing in any questions and answers. We'll stay on the line as long as you have questions. We will be having, we're going to be sending you some tools for that we're going to send the sample workers' comp proposal that you can use. It's a template that you can customize to your company, and a marketing piece to promote work comp with your clients. And then we will be sending you. Please go to our website to find out what other webinars we will be putting on. We are doing at least one a month, and they're all new and different. You can this particular webinar will be published on our site under the resource tab under under webinars, and so you'll see our upcoming ones, and you'll also see the recording of these, and you can listen to it again or have any of your staff listen to it. We also are going to do a survey, so let's see if we have any questions. What is considered medium or larger accounts? How would you answer that, Caesar?
Well, it depends on who you ask, but in my opinion,
yes.
If medium account's going to be somewhere between 10 and 50,000 ish or so. Smaller accounts are going to be under 10,000 typically. Anything over that, the 50,000 is probably going to be considered a large account, and that gets a little bit more underwriting done to it because of the size.
Got it. Okay. Let's see. I think I have a couple more questions here. What industries, businesses do you have an appetite or a good sweet spot for?
I get a lot of restaurants, a lot of auto repair shops, and a lot of Main Street type stuff. But we have a pretty wide variety of business types or appetite for a pretty wide variety of things that we can do. But homeowners associations is a good sweet spot. Property management as well. But it varies. The number of markets that we have a pretty broad appetite.
Good. Oh, I think so too. So another question, is description of operations sufficient for you to determine the class codes needed?
Sometimes.
I'll let you, Caesar.
Not all the time, but yeah, if you have a good enough description, we can figure it out. Again, a good resource is going to the WCIRB website, and there's a good tool there to type in a description of a operation, and then it can shoot you out some options for classification code depending on what you're doing.
Got it. And then one last question here. Could you please review once again details on calculating the net rate? Can you put the base rate and the net rate on your proposal?
Yes, you can, and it is encouraged to put the base rate and the net rate on there. And you basically take that base rate and then start subtracting all of the credits or adding the credits on top of that. So a $5 rate minus 10% credit minus another 50% credit for whatever you might have, and then you get your total from there. Really easy to do it with the calculator, and just figure out the net rate. But it's not very difficult to do that. But it takes some time to get used to if you're not used to applying all the credits and showing them on there. But again, it is encouraged that you show all the debits and credits on there.
And the reason I think so, it's so easy to lose, to confuse the insured. If you're not showing the net rate, you bet your competition's going to be showing it. And so your insured could get very confused and not think that you're offering as low a rate. So the net rate is super important to be shown by and broken down by each class code rate, so that you are always showing the lowest rate possible, and your competition can't steal your account from you then. So anyways, thank you all so much for joining us. We really appreciate you taking the time, and hopefully this was helpful.
Thank you, everyone.
Thank you.
Have a good day.